Well, good afternoon and welcome everyone. I'm Marie-Josée Kravis, the chairman of the Economic Club of New York, and I want to thank everyone who's on the line, who's joining us, and hope that both you and your family are well and that you stay vigilant and prudent throughout this whole period. I want to extend a special welcome to the members of the Economic Clubs of Chicago and Washington, D.C., as well as those from the New York Women's Forum and British America Business, who've also been invited to join us today. We feel a special responsibility of the Economic Club of New York as the nation's leading nonpartisan forum for discussions of economic, social, and political issues to try to share with our members as much as we can about the coronavirus. And today we have two of America's leading economists and also Economic Club of New York members, Larry Summers and Glenn Hubbard, who will be speaking to us on the economic implications of the COVID-19 virus. Larry Summers is the President Emeritus of Harvard University. During the past 2 decades, Larry has had an illustrious career in public service. He's held a number of senior policy positions in Washington, including the 71st Secretary of the Treasury for President Clinton. He was Director of the National Economic Council for President Obama, and he was Vice President of Development Economics and Chief Economist of the World Bank. As I mentioned, he's currently the Charles W. Eliot University Professor at Harvard University and the Director of the Mosavar Romani Center for Business and Government at Harvard's Kennedy School. Glenn Hubbard is the Russell L. Carson Professor of Finance and Economics at Columbia University, and he previously served as Dean of the Columbia University Graduate School of Business. In addition to writing more than 100 scholarly articles in economics and finance, he was chairman of the U.S. Council of Economic Advisors from 2001 until 2003. Glenn is also a former chair of the Economic Club of New York. He currently serves on the boards of ADP, BlackRock in fixed investment funds, and he's the chair of Metropolitan Life. He's the co-chair of the Committee on Capital Markets. To start, Larry will make some introductory remarks, and later he'll be joined with Glenn moderating the fireside chat. And Glenn has received questions from club members, and he's incorporated some of these questions in the questions that he will pose to Larry. The video conference will end promptly at 3:15, and as a reminder, this conversation is on the record, and we have quite a few members of the media participating in this call. So Larry, if you're ready, I'll pass it over to you.
Thank you very much, Marie-Josée, and thank you very much to everyone who has joined. If there is any blessing in the timing of what we are going through, it is how much easier it is to handle a situation of this kind than it would have been even one generation ago, when this kind of video conference would not have been something that was possible. The ability to share information, to plan cooperatively, to execute on complicated tasks is a respect in which our society is much stronger than it was. I would just record for discussion a few propositions. First, what happens here is ultimately going to be determined by the disease and by our success in containing the spread of the disease. No matter how negative the interest rate, no matter how voluminous the fiscal policy, if people cannot leave their houses to work in a job or go to a store, there is going to be a very substantial limit on what the GDP can be. Success in controlling the growth in the disease and ultimately putting it behind us is going to be the single most important determinant of the economic consequences of the COVID episode. There is nothing more urgent than progress in containing and controlling the disease, and any idea that it should be sacrificed to some other objective is, in my view, very substantially and seriously misguided. Second observation, I believe with respect to the economic response, Congress, the Federal Reserve, and the executive branch have made a strong start by acting with what, by the context of previous crises, is remarkable rapidity in legislating and mandating and establishing legal frameworks for a formidable armada of financial firepower. The Fed has gone to places that would have been unimaginable in 2009. The stimulus bill, or I think more accurately put, support bill passed by the Congress dwarfs the Recovery Act in the spring of 2009. But I believe that it would be a grave mistake to underestimate the difficulties and challenges of implementation. With the best of government performance, the challenge would be enormous, and it is far from clear that our government is operating with maximum effectiveness. We must redouble our efforts to ensure that everyone who is eligible for unemployment insurance is able to register in the week they become unemployed and is able to start receiving a check promptly thereafter as the law provides. That is not currently in place. Millions of the most vulnerable Americans currently are not going to be eligible for the universal relief checks that are provided for by law because they did not file tax returns in 2018 and 2019. That needs to be fixed. We need, as rapidly as possible, to establish clearly the principle that banks are functioning as payments agents and not taking full financial responsibility for the government guaranteed loans to small business, where those loans are to serve as a conduit to provide for the continued employment of the employees of small business and the provision of rent. We need, as rapidly as possible, to establish frameworks for the payments and loans that will be made on an extraordinary basis to medium and larger scale corporations. I believe that the overwhelming priority should be the protection of employees and not the protection of shareholders or bondholders who have been compensated with risk premiums for business risks that they have taken, including the possibility of acts of God, or what is referred to as Knightian uncertainty, or in Washington as Don Rumsfeld's unknown unknowns. I believe in particular that if Boeing were to receive substantial support without the government taking an equity claim, it would be manifestly inappropriate. Third, the United States, understandably and appropriately, has been focused on our needs at home. I believe that's an appropriate, obviously, the appropriate focus. I'm concerned that we have not moved as rapidly as we should have on testing, on the provision of ventilators, on the accumulation of masks. There is no reason why the United States should be in short supply on items of that kind. I don't see a reason why we have not been prepared to use emergency defense procurement authorities to the maximum extent possible to assure that those measures are provided. In particular, the idea that masks are selling to public authorities at 3 or 5 or 10 times normal prices seems to me to be offensive, and government should insist that that practice stop with the requisite legal authorities held in reserve if necessary. At the same time, we need to recognize that we are one planet with one biological reservoir, and that if we do not take actions to help contain the spread of these diseases in Africa, in refugee camps, in the Middle East, in India, in other parts of the world where some external assistance is almost certain to be provided, that will not just be a humanitarian catastrophe, but ultimately will raise the risks for all of humanity. The lack of international cooperation at the WHO and in the international institutions is part of what brought us to this point, and it is not an error that we should be perpetuating in the future. And I would just conclude by saying the single greatest mistake we could make would be a premature declaration of victory, the victory that we all want, and a situation where we all resumed lives of relative normality and then had to return to a situation like the present. And we must all be prepared to support our political leaders in making responsible, if painful, choices to avoid complacency and assure that the job of establishing a foundation for normality is firmly completed before there are any declarations of victory.
Thank you, Larry. What a difference a month makes. My guess is if we were having this conversation a month ago, we would be talking about vastly different subjects than many Wall Street economists suggesting very sharp declines in GDP and employment in the second quarter. Congress, as you noted, responding very rapidly with the CARES Act and prior legislation, and the Federal Reserve taking unprecedented measures in markets. I certainly share your thoughts that implementation is going to be critical, both on the Fed policies and what the Congress has enacted, particularly in unemployment insurance and the small business programs, as you mentioned. But I want to take advantage of the time we have this afternoon really to look forward. And I want to start out with the economic shutdown itself. In a frictionless world, you could imagine a light switch going off and then back on. And I think that's how some early discussions of the shutdown and its economic effects took place. But should we be thinking about the recovery from something like this as being like that, more like a so-called V-shaped recovery? Is it more like the Nike swoosh we've been hearing about in recent days? Or is it something smoother? And in answering your question, you rightly pointed to health, number one, but if you could draw on both the health information and the macro information, what do you think about the shape of the recovery?
So Glenn, my guess is that the downward move is going to be bigger and the upward move is going to be faster than the conventional wisdom has it. I look at the data on the distribution of occupations, and basically there's two kinds of people who can work and one kind who can't. There are people like many of the people on this call who can do their work at home, and there are people like many doing the hardest work in society, driving ambulances or driving delivery trucks or working in grocery stores, who of necessity are working despite the current condition. Those are the people who are working. I think at least a third of the labor force falls outside those two categories and will not be working. With a third of the labor force not working, GDP in the simplest way of thinking would be down by a third. I think that's an exaggeration because the people who aren't working probably have lower wages than the people who are working. But I think it's reasonable to think that GDP will fall by 20 or 25%. If you take that on an annual basis, a 1/4 drop of 20% is an annualized drop of 80%. Now, it doesn't coincide exactly with the quarters, but I would not be at all surprised if we see a 50% 1/4 drop. I do think the process of recovery is going to be somewhat different than the usual process from recessions, and therefore more rapid. I'm speaking from Truro, Cape Cod. Truro, Cape Cod has a depression where its GDP declines by 75% every winter. And then between May and July, its GDP rises by a factor of 3. And that just happens as a matter of routine every year. And I think that some of the kinds of processes you think of with respect to Truro, Massachusetts, will operate whenever the economy is permitted to return to normal. I think our programs will have caused many workers to remain attached to their firms, even where they haven't. Landlords will have seen no reason to evict tenants because they see no opportunity to replace new tenants. Workers who may have been laid off will not have been able to get new jobs. And so my expectation would be that we will be able to see a quite rapid recovery.
Okay, thank you. I want to turn to policy. With the Fed and the Treasury both taking very large steps to promote liquidity and credit access. Two questions, one about the Fed and one the Treasury. For the Fed, any advice on the design of the so-called Main Street lending facility? How should that work? And for the Treasury, there's this $500 billion in funds for large business assistance. How should that be handled? What kind of oversight is needed?
I'll say a couple things, and then Glenn, maybe I'd be interested in hearing your view, because this be something where I suspect we agree on some things, but there may be some Democrat, Republican, more progressive, more conservative economists difference. My advice to the Fed would be maximum deference to the Treasury. Seems to me that on the small business lending, it's not really lending. It's really providing funds. It's probably a good thing to provide funds, probably a very good thing to provide funds, but I don't really see that as the task of the central bank. We're not talking about providing liquidity to the pizza shop that's going to be closed for 3 months. If that pizza shop is going to pay all its workers, it's never going to earn enough profits to get that money back. And so that's granting money. I'm sympathetic to much of the granting, but I don't think it's a job that the central bank has the mandate or frankly has the competence to carry out. In my day, and I've been away from Washington for some years now, but I rather doubt that this has changed. The Fed had an awesome collection of PhD economists, and if you wanted to discuss what the natural rate of unemployment was, there'd be no greater convocation of experts possible. But if you wanted to factor a receivable, there weren't many people at the Fed who'd ever done that. So I think the Fed ought to provide liquidity as a backstop for the expenditures and the risk-taking of others, but should not be involved in making choices about the administration of loans, except as an advisor. I think the principle for the Treasury should be workers first, commercial terms wherever possible, protect the economic interests of taxpayers. If they're providing loans of a kind that are not available from the banking system, I think the government should be taking warrants in the upside of the companies. I think loans that are provided should be, as Badgett said, when you're a lender of last resort, lend at premium interest rates. So I think the terms should be commercial and economic, the kinds of terms that Mr. Mnuchin would have expected if he was doing the deal with one of his former employers, or if that was not possible, and upside in the form of warrants for taxpayers. I think there should be some set of protections that ensure that the money is not used to enrich executives, or that money is being paid out to shareholders in the form of dividends or in the form of buybacks, while the Treasury is still at risk. And I think there should be a reasonable expectation that what's being preserved is the enterprise as a viable business enterprise, not as a form of economic manipulation. I am not one who supports using these loans to pursue particular agendas, even when I believe in those agendas. When I was involved in the automobile bailouts during the Obama administration, we all in the Obama administration were of the view that an electric car agenda was a very important agenda. But I was nonetheless of the view that seeking to use the leverage of the government lending to push an electric car agenda on General Motors and Chrysler would be inappropriate. So commercial terms, middle class employee emphasis would be my principles for the Treasury. And in general, in lending to companies as in lending to countries, there's no reason to do it on the cheap or on a narrow margin. Lend enough that there is a real prospect for success and that there isn't a need to keep coming back again and again.
Yeah, I more or less agree with most of that. I think for the Fed, the role is really liquidity and market making. As you say, the Fed shouldn't be absorbing the large losses that of the treasuries. The fiscal policy should be done by the Congress. I think these grants are good policy for the same reason you mentioned, but I don't think of them as monetary policy. On the issue of the Treasury, it seems to me you'd want commercial terms, but terms that are reasonably articulated for almost all borrowers, unless there's some very special reason. I'd be a little more open to other means. I don't know, maybe preferred stock. loans plus warrants, but I do think you need a framework. I think taking common equity is not a good idea, but I think the loans and warrants or the preferred stock could be a very good idea. You referred, yeah, go ahead.
Just to check two things. I assume your aversion to common equity comes from the fact that common equity is voted.
Yes.
You're taking a controlling interest. And so
Correct.
if you non-voting common equity, that would, and control was issued via covenants in loans or some such, that would be fine with you. I would be inclined to agree with that. And just to augment something you said, I think almost everyone on this call understands that the Treasury is the 100% shareholder in the Fed.
Yeah.
And so when the Fed spends money, that's taxpayers spending money just as surely as when HHS spends money. But I think there are many people who don't understand that, who think that there's this piggy bank called the Fed that can be used to fund things. And I think if we all could understand that the Fed spending money was us spending money, it would promote better decision making.
I agree. There's only one balance sheet, and that's the taxpayers. I think there is an optical issue here. If the Fed were to lose, quote, lose more than the capital the Treasury has given it, while it doesn't matter as an economic matter, it might matter as a political matter. I think the Fed may be a little worried about that. You mentioned in your other answer lending to countries. I want to change the channel a little bit from the United States to emerging markets. So emerging markets have two stresses, at least from the pandemics. One is that their public health systems are more strained and inadequate as the United States. Whatever you may think of the US response, it will be vastly superior than in most emerging markets. And second, they lack some of the fiscal or monetary wherewithal to have the kind of actions we've seen in the US. So what do you see as the likely depth of a downturn that we should expect in key emerging markets? And what do you see as implications for the United States of that kind of downturn?
I suspect we're going to see the most serious emerging market downturn, certainly in the last generation, and quite likely since the Second World War. I look at some of the flagships among the emerging markets, India and Brazil and South Africa, for example, as appearing to be on very grave paths from both economic and public health points of view. It is hard to read the data out of China, but China is surely going to see the greatest interruption in its growth path since the post-1979 reforms, including Tiananmen. That, to the extent that emerging markets have come to be major major places to which the United States exports, that is going to be a barrier to U.S. growth. I think the more difficult challenge is that given the very substantial capital outflows that those countries are suffering, they are likely to see substantial pressure on their exchange rates, which they can't really control except by completely destroying their economies with high interest rates. And I think we're going to have to accept that it is not manipulation, it is the working of the market system, that the dollar is going to appreciate relative to emerging markets in depression for much longer than we're going to be in depression. And we would be making a serious mistake for the global economy, a serious mistake for the long run, for our long run relations with those countries, not to mention a serious mistake for the interests of US consumers if we were to confuse an emerging market economic catastrophe with emerging market exchange rate manipulation. And I think anyone who has followed the writings over the years or the pronouncements more recently of Mr. Navarro would have grounds for being concerned that that would be an error that the current economic team could make.
Following up on that, do you see this as a moment that the IMF and the US Treasury will have to restructure existing debts of many of these economies?
I think we're going to have to think differently than we have about the question of debt relief. If we do it the usual way, it will be 2022 before something meaningful has happened. I think we should lead in declaring some kind of structured moratorium on payments by emerging markets to their official non-international institution creditors. There will be time to work out the exact principles of comparability with banks. There will be time for discussions of appropriate conditionality. There are very important issues with respect to the fact that in a way that was not true earlier, a substantial part of the debts are owed, sovereign debts are owed to China. But I think some kind of initiative directed at a moratorium on debts to export-import banks, debts to agricultural finance, other such agencies would, I think, for some appropriately defined class of countries, would, I think, make a meaningful contribution at a difficult moment.
I agree with that. And what you're saying makes me think of a question to go back to the issues here in the United States. So think of two concepts of time, economic time and financial time. So economic time has stopped for the period of the shutdown for the good health reasons that you mentioned. If we were to think about a way to keep financial time going, are there ways to take the logic you just mentioned in emerging markets and think of a program of forbearance in some regards, whether it has to do with debt or certain payments for a period of time? Is there a way to bring financial and economic time together during the shutdown?
I mean, I think it's a powerful metaphor. I spoke at the beginning of the crisis as imagining we were going to have a few months in which every day was going to be Sunday or every day was going to be Thanksgiving. People weren't going to be working. They weren't going to be shopping. They were going to be home with their families. The only thing is that, as your example suggests, debts will be accumulating. There is language in the legislation, and there have been policies pursued by a number of local governments and even some encouragement from the president around mortgage payment moratoria, eviction moratoria. I think we have to be rather careful with respect to that. And the reason is, when I spoke about it in the international context, I said for an appropriately selected group of countries. There are no countries with per capita incomes of $1,500 that are currently paying their debts comfortably. And so if you declare a moratoria, you're helping them and you're not creating any other problem. The vast majority of Americans, even in this difficult moment, are paying their rent, are paying their mortgage, and are paying their credit card bills. And if you license wholesale moratoria for everybody, unrelated to Corona, you risk a set of follow-on consequences where lenders become unwilling to lend, landlords become unwilling to rent. So yes, we need carefully designed approaches, but they need to be tied and linked in some way to disease-related distress, in my view, rather than creating a situation where no matter what happens, no one can be evicted, which I think runs the risk of upsetting the subsequent capacity to lend so much that you may do more financial damage than good.
Thanks. I'll make sure to pay Columbia, my landlord, today to echo what you said. We just had a very large increase in borrowing. And in some respects, you can think of this almost like a war, where the nation has a battle. It takes on a very large one-time increase in debt. The debt to GDP ratio over time comes down because you have future growth, and that was one-time debt. Are you worried at all about the borrowing that we've just done, or about future fiscal packages that you and I both think are probably likely, as to what that might do to the debt dynamics facing the country? Or is it fine just to stick to, this was like a war, it's just a one-time blip in the level of debt, and I'm not worried?
I think the answer is, Glenn, that I am concerned, but I think of a lot of this borrowing as being an investment. If we were not to borrow, if the Depression were to become that much more serious and continue that much longer, if we were to have that much more ill health, our solvency as a country would, I think, not be improved. But I think we do have to be mindful of the risks associated with taking on debt. But in my view, at this moment, the risks of underinvesting in our future and underborrowing far exceed the risks of over borrowing. Remember, we are now able, as a country, to borrow money for 30 years at about 120 basis points in a currency that we print ourselves. There is an incredible number of things that we as a country can invest in that will have a return in nominal dollars that exceeds the 120 basis points at which we can borrow. And so I think the prism of cost of borrowing versus return on borrowing is a better overall prism for thinking about fiscal policy than the prism of what is the overall debt to GDP ratio, and does that debt to GDP ratio look abnormal relative to some past moment. I think the experience of Japan, which has reached debt to GDP levels that observers 15 years ago would have said you just can't reach without having financial chaos come down on your country, but in fact has happened essentially without incident, and has happened without incident because the debt service to GDP ratio has actually been abnormally low in Japan is instructive. Someone who gave advice to a home buyer that was only focused on the ratio of their mortgage to their income, without regard to the size of their mortgage payment relative to their income, and without regard to how fast their income was likely to go up, would be a fool. And in the same way, I think these analyses that are entirely centered on debt to income ratios are misleading. But that doesn't mean we don't need to track and think about the likely future of debt service ratios and think about the sustainability of low interest rates. I do think, I'll just add to this, I've been saying it for years, but everything about this crisis is reinforcing the secular stagnation kind of view. It is creating uncertainty that is going to reduce investment and is going to increase saving. And so whatever you thought about where the neutral interest rate was going to be going forward, you almost have to think it's going to be lower now, and that points towards a more active fiscal policy. And rather remarkably, if you look at forward real interest rates as inferred from swaps or treasuries, even 10 years out, despite the disinflation that we've seen, despite the huge move towards greater government borrowing that we've seen, those forward real interest rates have declined quite substantially in the last month.
Yeah, I think.
Sorry, I wish we could continue because this is really quite informative, and I know that our members would love to hear more of you. We might have to have you back in the not too distant future, but we need to sign off now, and I want to thank both Larry and Glenn for your insights and for taking the time to be here, because I know there are lots of demands on your time right now. So thank you for joining the Economic Club of New York. Just want to say that going forward, we'll have more events such as these, and as I said, maybe a repeat event with our two panelists, and we will keep you apprised on a month-to-month basis of how the program evolves. Just I want to encourage everyone to continue to be safe, to be prudent, and I wish you and your families well, and thank you for joining us today. Thank you.
Thank you.
Thank you, Marie-Jose, and thank you especially, Glenn, for the very thoughtful conversation.
My pleasure. Thanks, Larry. Thanks, Marie-Jose.